Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review, this time for the week ending May 23rd, 2025. So the title here on the week is Fiscal Fears. We went from trade war fears to a sense of calm, now to fiscal fears. But the bad news is that all of those things are starting to wrap into one and are pointing towards, again, more volatility ahead. But of course, this is Trump 2.0, so it never gets boring with the Trump at the helm. Before we get into the details, maybe let's start with a look at this week's markets at the close on a Thursday. So as you can see, lots of red for bonds. Rates are higher because of the fiscal fears. This is limiting risk appetite. So stock markets also went south during the week. For the most part, the USD continues to be weak, so the Canadian dollar, euro are higher, price of oil lower, gold higher as there are some geopolitical risks and of course fiscal risks and inflation risks. So again, safe haven, that role that the gold is playing, played it well this week with a return of about 3% on the week. So as is the tradition, let's start with an update on tariffs. And it's not a coincidence that this morning on Friday, we're starting to have Donald Trump, waking up in a bad mood and starting not tweeting, but truthing. I don't know how to call it now, but about Apple facing potentially 25% tariffs if iPhones are not made in the U.S. Apple has explained many times that there's a reason why they produce in China or in India. If you produce those iPhones in the US, they're going to be costing much more and you need to build the factories for that and it's costly. And is there really a market for US made iPhones that cost more because they're made in the US? So let's see how this unfolds. But Apple being so large in the index and so important for the stock market, there are some risks here of volatility coming from just this news here. And Trump is threatening a 50% tariff on EU goods starting in June because the discussions are going nowhere. Remember that in 2018, and we mentioned that last week, when China signed had a tentative deal with China, it wasn't long before he felt that the conversations were going nowhere and he went back with the tariffs. So, could we see this also with China? So it just brings back the risk of the trade war to the surface. But when I said that it's not a coincidence that we're hearing this morning, because a few things happen on the fiscal front this week. If we go to the next slide, last Friday after market close, so we didn't cover it in the review here because it wasn't announced then, Moody's downgraded the US credit rating, citing growth in government debt. So S&P 500, the S&P agency downgraded the US in 2011. So it almost 14 years ago. Fitch followed in 2023, and the only one standing was Moody's, and they just acted. So now all three big credit agencies have downgraded the U.S. to AA or whatever the rating that they use. On the bottom left, you have the reason that was cited. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest cuts, so the trend is not favorable. You had that last Friday, and this week you had the one big beautiful bill. It's the real name of the bill that went through Congress. It was approved by Congress, by a very slim margin after a night of negotiation, and now it's heading to the Senate, where there will be some more modifications, some more negotiation. Should pass eventually, and the goal, which is an aggressive one according to the people involved at the White House. The goal is to bring it to Donald Trump's desk on July 4th. So there's still maybe a month or two of negotiation ahead of us before we see the end of that bill. But that bill includes a permanent extension of the 2017 Tax Cuts and Jobs Act tax cuts. So, no change to the U.S. consumers now, but it would make the tax cuts permanent, so more pressure on the fiscal situation. An array of new tax write-offs, so tax deductions, tax cuts, mostly for the most wealthy. Transform social safety net programs, so some cuts on Medicare, Medicaid. And, when you look at the details, the richer Americans would benefit from that, and the poorer Americans would have less at the end of the year based on this bill here. And the CBO, so the Congressional Budget Office, estimates that the bill's tax policies alone will add nearly $3.8 trillion to the federal deficit over the next 10 years. The government is saying $2.75 trillion. There are some independent estimates that say as much as $5 trillion. So adding even more to the debt and to the deficits that the U.S. is running year in and year out. So just pause here before we go into the charts. This administration's priorities are to cut taxes, cut spending, and to pay for that through tariffs. So there's three parts to that stool. So tariffs, tax cuts, and spending cuts. Now, with this bill here, they were able to cut spending some, cut taxes a bit more, so that creates a deficit, and you need the tariffs to pay for that, for this thing to hold. But now the bond market is starting to bring itself into the conversation here and say, well, maybe this is not sustainable. Rates are rising, and when the bond market speaks, usually the government listens. So it's not a coincidence that this morning, after this bill has passed, it was narrow. They know that in the Senate, it could be hard to pass it. They need to avoid, a fiscal situation where the bond market just, disciplines the government here. So that's why Donald Trump is pushing for his tariffs this morning. So if you look at the charts, on the left, you have the budget surplus or deficit as a percentage of GDP. So negative means a deficit. Now we're at close to 7%. Just the interests on the debt amounts to about 3% of the US GDP a year. So, that's a big part of that. And as you can see, the trend is lower. Of course, there was the spike during the COVID, but the trend is getting wider and wider here. So market is reacting to that. And on the right, you have the total debt held by the public. There's a forecast starting in about 2024 all the way to 2040. So right now it's about 100%, but if we stay the course, we will go to 120% by 2040. So it's just rising and rising. If you look at where we were at the beginning of the century here, about 30-40%. So that's been quite a rise in the debt to GDP ratio in the US. So we're on an unsustainable path. And the idea, if it's stable, that could be even if debt levels are high, if it's stable, or if there's a plan to bring it down, usually markets will accept that. But if the plan is always to bring more and more deficit on top of the current debt, well, of course you're going to have some issues. So question is, are the bond vigilantes taking over? So here you have the US on the left, Japan on the right, the 30-year rate. So there's two different stories here, but in the US now the rates are, they touched 5.1% this week. We're pretty much at the highest level since 2007, when growth was very strong, inflationary pressures were there. It was just before the financial crisis, when there was lots of leverage in the economy. So investors are taking notice of these levels here that we're reaching. So bond vigilantes, maybe they're coming, but you do feel the nervousness in the bond market. On the right, the Japanese yields, I need to bring that because it's been very important, covered everywhere. It's not really the same thing. It's not that investors are worried about the solvability of the Japanese government. It's more about the pension funds and the insurers in Japan that seem to have less appetite for the 30-year bonds. There are some other opportunities elsewhere that they're trying to tackle. There's pressure on the Bank of Japan, who's just letting go bonds out of its portfolio to maybe buy more long duration bonds, less short duration bonds. So there's lots of things happening in Japan. But if you look at multiple 30-year rates around the world, you are seeing this upward pressure. So it's just like trickling in some small anecdotal stories left and right, but if you bring them together, you do start to see this nervousness. And if the bond market is nervous, usually an accident there could have some important consequences. So again, for Donald Trump's policies to work, he needs to tackle spending cuts, tax cuts, and raise revenue from tariffs. And if his plan is not seen as credible, there's a risk of a fiscal accident, or the bond market just not liking it and sending a strong message and pressuring the government in backing off. And if they back off, they cannot back off on just one part of that stool. They need to review everything. So that makes the situation pretty fluid. So that's why I wanted to cover all of this here today with you. So we'll keep you posted on how things evolve, but things are always interesting with Trump at the helm. What we'll be watching next week in Canada, we'll have GDP in March. In the US, we'll have two confidence indices, Conference Board and University of Michigan. We'll have the FOMC meeting minutes, so we'll see what the Fed is thinking. And of course, core PC inflation, the most important inflation report, the one that's followed by the Fed, should be pretty much sideways, 2.5% year over year, 0.1% month over month. No reason for the Fed to think that it's time to reverse course and start hiking, but again, nothing to just pressure the Fed to start cutting either. So likely the first cuts from the Fed are a ways away here. So that wraps it up for the week. Always a pleasure to serve you. If you enjoy the content here, of course, please share and come back again next week.